Today is Tuesday, January the 2nd, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, and Alan Bush, ADMIS Senior Financial Economist. Happy New Year, fellas. Starting with the grain markets this morning, Mark. What are the key factors that will drive agricultural markets in the early part of 2024?
Well, I think South American weather will continue to be the main driver of ag values over the next 30 to 60 days. Increased rains over many of the dry areas of central and northern Brazil in the last week to 10 days have increased crop prospects moving forward. Question becomes, was it just a little bit too little too late to help some of the earlier planted crops that experienced heat and dryness in Q4 of 23? Most private corn and soybean production estimates for Brazil are coming in about 8 to 12 million metric tons below the USDA estimate, while production in Argentina is now starting to inch up a little bit. Domestically, we have a critical USDA report a week from Friday on the 12th. Here, the USDA will provide final production figures for both U.S. corn and soybean crops from last year. December 1st stocks will also shed some light into usage figures in the September through November timeframe, while the USDA will also provide their first estimate on 2024 winter wheat acres. This is a very key, big report here that often shapes ag values into the first quarter of the calendar year. Then we also, of course, have two wars that have the potential to disrupt the flow of ag trade, while also the U.S. Federal Reserve and their continued effort to dampen inflation while engineering a soft landing appear to be poised to start lowering interest rates here in the first half of the year.
Mark, looking at the bean oil market, what will it take for bean oil prices to bottom?
Well, recent data from the EIA has, I think, really confirming what the bean oil market has been telling us since July, when prices peaked at just over 72 cents a pound. And that is that alternative feedstocks have been able to absorb much of the added demand from the increased renewable diesel production capacity that's coming online. Capacity increased another 3% in the month of October. However, production fell 8%. That fell to a 6-month low. Bean oil usage fell 12% for the month, which was also a 6-month low at just over 1,050 million pounds during the month. So while bean oil is still the largest feedstock used in biofuel production at 36%, it has fallen now to a 3-year low. We've seen yellow grease or used cooking oil start to increase. That is now up to 23% in this latest figures. So to me, to get prices to bottom out, we'll need to see crush margins improve. We get another monthly crush update here this afternoon. But with the pullback in bean oil prices now, I think they're becoming more competitive as capacity expansion will continue into the new year. So now with prices under 48 cents a pound and money managers holding their largest short position since June of 2019, I'm thinking much of the bearish news has already become discounted.
One more question, Mark. Can you give us an update on how the large speculative trader is positioned when it comes to the ag markets?
Yeah, Kurt, we've money managers continue to sell into this lower ag trade. They sold another 36,000 contracts last week, extending their short position to nearly 250,000 contracts. And that is their largest short position in the ag space since June of 2020. So money managers remain pretty heavily short corn, wheat, bean oil, now flat in the soybean market, still holding a modest long position in the soybean meal.
Alan, here we are in a new year. What major policy changes are likely in 2024 from the major central banks?
Okay, the Federal Reserve will probably be the first major central bank to lower interest rates, possibly at its March meeting. Later this year, it is likely that the European Central Bank will be easing credit conditions, and then followed by the Bank of England. The Bank of Japan is somewhat of an outlier and is likely to take an opposite position, removing some of its ultra easy monetary policies by eliminating its negative interest rates. Currently, their key rate is negative 10 basis points. So later this year, the Bank of Japan will probably go to a zero interest rate policy and away from the negative interest rate policy. So since the Fed is likely to lower interest rates first, the US dollar will probably be the weakest of the major currencies, and the yen, with their less likely accommodation and their more restrictive policy, will probably be the strongest currency this year. So the dollar likely to be, once again, the weakest currency, and the yen likely to be the strongest currency.
And looking at the precious metals markets, what are you seeing for the gold and silver markets in particular?
So the main driver of gold and silver is the interest rate outlook. And as I just mentioned, so many central banks are likely to be cutting rates this year. So if that is the case, gold and silver will be supported by their dominant fundamental, easier credit policies globally from at least most of the major central banks. Also, we have the ongoing geopolitical risks, as Mark mentioned, the two wars. So all of that is supportive. Of course, geopolitical risks mean flight to quality flows, and a lot of that is historically gone into gold. So I think the gold has a lot of fundamentals going for it, silver also. So expect higher prices for both gold and silver.
Lastly, Alan, how about a rundown on this week's potentially market-moving financial reports?
Okay, on Wednesday, we'll have the December Institute for Supply Management Manufacturing Index guessed at 47.2. We'll have the Job Openings and Labor Turnover Survey, commonly referred to as JOLTS, guessed at 8.75 million. And then we'll have the minutes from the December FOMC meeting. That was the meeting where the Fed became surprisingly dovish. So we'll see what those minutes reveal. Thursday, then we'll have the December ADP employment report, guessed at up 115,000, and the December purchasing managers composite final at 51. And then on Friday, we'll have a series of employment reports. Non-farm payrolls guessed at up 158,000, private payrolls up 127,000, and the unemployment rate anticipated to be 3.8%.
Thank you very much, guys. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.